Welcome everyone to the first panel discussion of the day, Reconciling Financiers' Short-Term Profitability Requirements with Businesses' Long-Term Visions. This is an interactive session, so if you do have any questions for our experts, please do post them on the right-hand side and we can pose them to the panel and see what they have to, what insights they can share with us. Our panel experts for this session are Bastien Maucet, I hope I pronounced it correctly, partner at Venture Capital Mauritius. Bastien firmly believes that venture capital's role in Africa is to support economic and social development by fostering innovation. Before joining, Bastien has worked for leading financial institutions and consulting firms in Europe and Africa, including the position of board director at Chatbot and Omniscient. We also have our esteemed Uwemakpan back from our previous session, Fund Operations Director of Ingressive Capital in Nigeria. So to start off the session, the leadership challenge of balancing short and long-term business pressures and doing so in an ethical way in which both a company and its stakeholders can thrive is a challenge that's well known to all business leaders. So the first question I'd like to kick off the panel discussion with is, what are the financiers' current short-term profitability requirements that a typical startup or SME, as we know there is quite a vast difference between the two, what could they typically expect? Uwem, do you want to take?
Don't take that. Okay. To be honest, especially on the African continent, we're very short term. We're short term, and it's quite understandable because of the economic landscape. Everybody wants to make as much money as they can before there's a devaluation, and then you want to make your money and then convert it to dollars and move it offshore. So I see the problem, but I also for startups, the important thing, especially at the early stage, and I said it in the last conversation, is at the pre-seed stage, you're sort of focused on a bit of profitability because that's what the investors in Africa kind of focus on. They want to know that your business is profitable enough. In short, there's more focus at this pre-seed stage on profitability than on scaling. It is when, because in Africa too, people tend to see profitability in relation to product market fit. Because if people are really buying your products or service or using, then you're going to be profitable in a short term. So it's important for pre-seed companies and even financiers to strike a balance, really. Know that at the early stage, yes, you're looking to be profitable. Yes, you're looking for companies that are profitable and have figured out their customer base that they're trying to reach. But it's also important to look the long term and understand that if this company is going to be successful, they have to scale, and are profitable, not necessarily be at the forefront of what your investment thesis, really.
Bastien, anything that you'd like to add to that statement?
Yeah, I mean, I think what you have to understand is that there are a wide range of financiers, of types of financiers, and a wide range of SME, startup, early stage company, however you want to call it. And the fact is that each financier has its own framework of analysis when it comes to now prospect of profitability for a company. For example, a bank is not really interested in profitability. The only thing that the bank is interested in is that the company has enough cash flow to repay the debt. So it's not about getting a dividend or looking to sell the company for profit. It's only about the loan getting paid back. And that's why a bank will probably look more into the debt service coverage ratio rather than the profitability margins, for example. For VC investors, it's very different. And like Uwem said it, if you invest in early stage startups, you would probably not look at the immediate profitability of an early stage startup, but more the medium to long-term profitability prospects, because you know that an early stage startup is unlikely to be profitable before it's gained some traction, it's attracted enough consumers to lower its costs of acquisitions and get the unit economics right. But you want to know that, in the long term, a startup can be profitable, and it's in the mind of the founders. So I guess, for I mean, I'm a VC investor, so I'm going to talk about, you know, how I see things, and I'm not looking for short-term profitability in a startup. What I'm more looking for is that you know, the company is agile enough to be able to reduce its expenses when its revenue goes down, you know, in the middle of a pandemic, for example, and to stretch its cash resources to buy some time to wait for the time clear. So yeah, again, it really depends on the type of financiers you're looking to attract. Each one has its own criteria in terms of profitability, of short-term profitability when they look at companies.
Just to quickly add, people also, the regulatory landscape is also something that they always look at. So while you're building a company, you're looking at an investor, or while you're an investor, be it by traditional bank or an angel investor, you're also looking at the regulatory landscape to see, especially in, I'm going to use West Africa as an example. You find out that regulation and government tends to regulate than to support. So you always look at that regulatory landscape to ensure that there won't be a problem in the next medium to long term period.
I think it's very much, again, going back to your point earlier, when it's about finding the right investor who fits the concept that you're trying to sell.
Absolutely. I mean, it's been mentioned by Uwem and Zach before that. I mean, you know, the investors are always looking for a good match when they invest in a company, but it works the other way around. A company and the founder and any entrepreneur should be looking for the investors that matches their vision, their moral and their ethics value, and the kind of investment that they want to attract in terms of amount, in terms of you know, interest costs, in terms of term of lifetime of investment. I mean, all these factors have to be factored in when you look for an investor.
Yeah. That brings us to the next sort of question is, how can a business sell its long-term vision to investors specifically? What would their approach be? Where would they sort of start from? What's the starting point in that?
Well,
okay, Bastien.
Okay, I mean, for me, a long-term vision is based on structural trends, which will affect durably the way product and services are consumed and valued by users. A long-term vision cannot be based on exceptional factors randomly and momentarily disrupting an environment. And to sell a long-term vision, for me, it's a twofold process. First, you have to be able to convince your audience, I mean, in this case, probably your investor or your banker, that the trends on which your business model is based are so deeply rooted that they will induce material and foreseeable behavioral changes over the longest period possible. And this particular part of the convincing is usually based on data and facts and market research and analysis. It's this part of the convincing process is a very matter-of-fact part, and you have to clearly highlight the fact that the trend you're looking to exploit is backed and it's supported by actual data from your past professional experience, from experts, from any kind of data with a recognizable source. Then the second part is actually being able to convince your audience that you are the right person and you have the right team to harness this particular trend. And this goes through a more soft skill process, being you have to, while you have the hard data, your market analysis, your trend, then you have to sell it. And this is more on the soft skill side. It's based on your charisma, it's based also on your education, your qualification, your professional background, any achievement you have, and the will you have to convince, and the conviction that you convey when you present to an investor. So basically, you have to be able to sell a long-term vision. You have to have your long-term vision supported by facts, and you have to be, I don't know, charismatic enough and convinced enough that you can yourself convince your investor.
I said it's a case of building trust, and I like to always refer back to the African context. We are not so good at selling ourselves, so you see very smart, very smart founders, but they can't sell themselves. And to build trust, you must be charismatic. You must know how to sell yourself, but you must also have a team, a very good team behind you. So while you're selling yourself, while you're basing everything on the data that you've gotten, you have to build a team that can push that vision. You want to show the investors or whoever you're speaking to that you have the team to bring the returns that you're looking out for. And then maybe lastly, you can also refer, and well, this is tied to data, adjacent markets, to say, hey, XYZ is doing this in India. It has worked for them. Look at Nigeria, similar markets, similar demographics, and see, we can actually try to replicate the same thing in this part of the world, and it will work. About building trust. Trust is the fundamental principle behind, building a long-term relationship.
Yeah, I think Uwem is absolutely right. I mean, the fundraising process in venture capital can take like between 3 to 5 months, maybe more, sometimes shorter. But the fact is that before you get into the proper fundraising process, there is the way we do it, the way I've been doing it for the past few years, is that I usually get to know the founders on a personal level before I go in the project that they're selling. And the last investors, one of the last investment we've done early 2020, we spent, it was 2 years after we first met the founder. And it's all about building trust, because it's a long-term partnership. When you invest in a business, you're going to be stuck with the founders, so to say, for 5 to 10 years, maybe more. So if you're not able to connect with the founder beyond the purely professional level, you won't be willing to spend the time you need with the startup to help the startup succeed and the founders succeed.
Absolutely.
Bastien, when you talk about how long the process is, it's quite a lengthy process. Do you find that sort of the amount that startups are applying for impacts that sort of timeline, or is it irrelevant? You would do that amount of research, the same amount of research for a $50 million versus a $100 million application?
I don't think there is a direct connection between the amount that the startups are trying to raise and the time it takes to actually close a fundraising round. I think it's more about the culture of the investor, of the investment firm. Some have streamlined their processes and are very efficient in the way they analyze the investment, the way they run the due diligence, the way they issue the legal documents. Some of them are more working in a traditional manner. So it's more, I think the length of the fundraising process is more linked to the nature of the investor and the way they do business rather than the size of the round.
What is the sort of process on your side? What do you see there?
Because and this is just my own personal feeling, because I know that fundraising can be a brutal affair for founders. I try to shorten the process as fast as I can. For Ingressive Capital, we try to reduce the process to 3 to 5 weeks. That's the ideal case. But when you're doing due diligence, because you want to build rapport with the founders, we find out that is in this and things that would typically will not typically accept in our founders. So I think it's usually drawn out because you want to be sure you're making the right decision. Be it a $5,000 check, be it a $250,000 check. I've seen somebody write a $250,000 check after the first meeting. It's still, like I said, it depends on, like Bastien said, actually, it depends on the investor you're speaking with.
I suppose that it depends on the investor that you're speaking with. That's how you would define how you approach it and how you'd approach them for the funding.
Yeah.
Okay. Before we move on to the next question for the panel, I'd like to just remind everyone who is attending the session, please do feel free to pose your questions on the right-hand side. We will ask the panel experts for their insights on it. So if you do have any questions in terms of capital financing, please do just pop on the right-hand side. In the meantime, on to the next question. What financing options are available right now for entrepreneurs and startups? I know it might be country dependent, but as far as you know, what are the options that are out there?
Well, I mean, there are a wide range of financing options, ranging for equity funding to debt funding to quasi-equity, coming from business angels, venture capital funds, banks, private equity funds, any kinds of grants that can be granted by university, by non-governmental organizations, foundations. You've got family offices. I mean, the list goes on, and I think, you know, again, it's more about what kind of company you are, and it will define the kind of funding you want in terms of is it debt or equity, and the kind of investor you're going to get it from. But I mean, it's it's a very large question, and it's also very dependent on where you are. I mean, at the time, for example, lots of banks in lots of countries are benefiting from are giving away loans guaranteed by governments to reduce the effect of the COVID-19 on businesses. So it's really also a question of market timing. I want to say about, you know, what kind of funding options are available to entrepreneurs.
And you forgot friends and family.
Yeah,
I think
exactly.
that's the most popular at the early stage.
Yeah, absolutely.
Crowds from the friends, the family, the fools who that just believe in them. Like you said, it's all dependent on what stage you are in your business and the responsibility you're ready to take. I always tell people, the minute you start taking in money from anybody, whether you're friends, whether a traditional investor, be ready to be responsible to give reports. If you're not ready to do that, you know, monthly reporting, if you're not ready to answer to people, stay on your own, reinvest your profits back into your business, because taking on money is responsibility, a lot of responsibility that people typically are not ready for.
Yeah, and it's heavily dependent, like you said, Uwem, it's heavily dependent on the stage at which you are in your business. I mean, if you are very early stage, like just, you know, drawing some projects on a napkin, you're probably not ready to go to see a venture capital or a bank. You probably want to bounce back the idea to some friends, to maybe a businessman or two out of your network, and see if there is an interest before, and leveraging their help to, you know, to grow your business further, and then move to the next type of investor.
We have had a question from the audience. Do the venture capital firms look at what accounting or financial management support the founders will have going forward, or is it normally the venture capital firm that will dictate what the accounting systems and accounting partners use? They feel it's relevant as founders are not normally financial professionals. What's your view on this?
So the way VCs operate and investors operate vary from, I mean, depending on the region, depending on their own thesis. And for us, while we all agree and we know that access to finance, just that money is not enough, really. It's not enough on the African continent. You know that they need some sort of support. And what we do is we provide that support through our partner of firms, through intros to consultants that can help you, through intros to financial institutions. So, I mean, not everybody likes numbers. Personally, I'm in the numbers game, but I do not like numbers. It's just so weird. And I find out there are so many founders that are in the same, I mean, when it comes to the monthly reporting, they're like, oh God, what is this? What are all these numbers? This doesn't make sense. And while we handhold over to professionals that can help them build a structure, and help them build a report that makes sense to them and to the investor. But as a founder, you have to know the basics, really. Whether you're a financial professional or not, you need to understand the basics, because, I mean, You cannot grow your business if you don't understand, if you don't know how to interpret the basic data.
Yeah, I think, you know, at the inception, accounting and finance has to be part of the founding team skills, because like Uwem is saying, it's you don't have to be a professional in finance to create a company, but if you're going to raise money and go through the fundraising process that startup go through, you have to understand a bit how it works, and it's better to have this skill as from the beginning. Now, if you don't have it, it's not a deal breaker, because a startup is a very fast evolving machine and animal, meaning that you can start with you know, one of the founders being the accountant because he has some knowledge of it, and at the early stage of a startup, I mean, the amount of accounting work you have to put in the business is not that many, because it's a simple business. You have you know, one line of revenue, you have a few expenses, but it's not very complex. The more you know, the faster you grow, and the more you get to meet and to discuss with investors, the more complex it becomes, and you need to have some kind of legitimacy in terms of, you know, presenting financial statements and accounting statements that are relevant and that can be trusted. That's when you need to move up to accounting firms, first local, and then if you go global, cross-border, then obviously you have to go with more global players as well. But you know, I mean, the accounting support a startup needs, it's an evolving, it's a moving target. It's not set in stone. So you can adapt, you know, given the stage you are, and choose the right accounting resources you need at this particular moment.
Okay, great. We are running a bit ahead of time. Do you have any closing statements or top advice for entrepreneurs and startups when they are looking to approach investors and funders? What's your key takeaways here?
Well, I mean, the main thing that I'd like to share right now, given the particular context we're in, is that, you know, like adverse market conditions are not a reason to abandon or to give up on a long-term vision. If you have a very ambitious vision for your business, don't sacrifice it just because COVID-19 is making things difficult. Just take a step back, rethink the way you see your business and the timeline you have in your head for your business, and resize your expectation and the amount of funding you want to get based on this. That means basically don't go to an investor right now and say, listen, I have this idea, it's the next big thing, I need $500 million right now to grow it to be a world leading company in 5 years. Because it's not the right timing. It may be interesting, and again, don't give up on the vision, because that's what makes, you know, investor tick. But go to an investor with this vision and say, but given the circumstances, what I'd like to try is a localized, more limited business plan to validate my assumptions, to validate my unit economics, and to wait for the better time to scale, and ask for a lower amount, because an investor can hear that. It's hard for an investor to write a check to a first-time founder for $500 million in this kind of times. But, you know, working on a kind of proof of concept for your business on a smaller scale with a lower amount to validate some assumptions, an investor can hear that. And if you do it right, if you execute it right, because execution is paramount, then you will be able to fund your scaling in 1 year or in 18 months, and then you will be able to run after your vision. So that's the kind of advice I want to give to founders right now, because situation, you know, the context is particular, to say the least.
I'd like to just repeat one thing Bastien said. Execution is paramount. Execution is key. And I tell founders that are always afraid to, you know, pitch their business. Don't actually execute your idea or your business better than you. So you're the key executor. So take care of your mind space. Take care of the people that you have working with you, because they help you drive the vision. Silence or a no from an investor is not the end of the world. It doesn't mean that your business would not be successful. So, I mean, as an entrepreneur on this continent, you're ready to get a lot of no's. and then be wary of dilution. I see so many people, but you forget that by the time you raise your pre-seed, your seed, your series A, B, find that some founders barely own 2% of their businesses or 5%. So be careful around dilution. Raising a success. So at the seed stage, you raise $10 million. It doesn't mean that you're going to be successful. You find out that this year, a lot of companies actually had to do down rounds. So they raised the high amount at seed stage and then went to Series A. They had to do a down round because the investors did not believe that their valuation was worth it. So you have to be careful when raising your money. Like Bastien said, for the stage of your business, to validate your business and to show the investors that if they keep on backing you in the future, you can do way, way better.
And just to bounce back on this, there is a TV show actually for people that don't have the inclination to read books about how to grow startups and stuff. There is a show that aired on HBO about like 5 years ago, which is called Silicon Valley. So it's a comedy. Yeah, it's a comedy, but it takes on lots of challenges and topics that as founders you will run into at some point, particularly the dilution thing. Like you don't have to accept money because you're being given money by investors. You have to think about your dilution, the way taking money is going to affect your business, in the short-term future, and also the next funding rounds, and avoid down rounds at all costs. So I suggest that if you want to have a quick look in a fun way, you should watch Silicon Valley.
I agree. Love it.
Yeah, I did.
It's a great part. We've just another one comes through. What questions should we ask when figuring out our capital raising strategy? Uwem, do you want to start with this one?
I think I and Bastien have answered it. Figure out what stage, in your product life cycle, your business life cycle are you in? How much do you need at that point in time? Talk about dilution. Also look at the investors that are interested or available in your current market. What are they looking out for? And then, exactly, what are they looking out for? Some investors are looking out to see if you're accelerating your business using tech. Some people are looking for traditional businesses. Some banks are looking to see if you can repay your loan. So depending on the investor, the person you're looking at, it kind of defines your capital raising strategy. And then lastly, I would say that look at your bond rates, and you look at your bond rates and use it to determine how much you will need over a period of time. Because I see people just cook up figures from nowhere and say, hey, I will need 500K to last me between X period and Y period. But when I start asking, drilling down into the numbers, what is your bond rate, how much, what is your operating, you start hearing all sorts of numbers fly around that don't add up. So you really need to do your homework, because some investors would actually drill down into the finer details to find out how much the money will last for you. It's important when you're raising money to know how much the money will last, because everybody, especially when you're talking to the VC wants to know when next you will raise. Very, very important, because then they can plan either their follow-on, they can also kind of project how well you're going to be doing when you're going to raise in the next round.
Bastien, anything to add to that?
Not really. I think you covered pretty much everything.
And lastly, what are the top 5 industries that you're seeing investors investing in currently, especially through this time? Do you see a spike in any of them? Are there any new players to the group?
There has been maybe a more an increasing focus on health tech recently, given the COVID-19 situation. But apart from that, I haven't seen any big shift in the trends of investment across industries over the past few years. Fintech has been on the forefront. Agritech is maybe moving forward a bit because of people, being more and more aware of the challenges of feeding 8+ billion people over the next up to 10 billion over the next 15 years. Yeah, that's what I've seen lately.
And just to add to
And
Bastien,
Lagos?
yeah, well, right. So these industries were there, people were investing, but we're now seeing more people chance, and then fintech has been at the forefront because there's this drive for financial inclusion. Logistics, last mile delivery. In general, we are such a big continent. We are connected, but we're not connected. You want to ship something into from France to from Senegal to Nigeria, you probably have to ship it to France before you bring it into Nigeria. So we are beginning to see more investment in that logistics space. Agri-tech, although agri-tech has really suffered during COVID, you're seeing health and wellness. I know health tech, but you're beginning to see more, mind space, wellness platforms. What I always tell people is before you change direction or pivots, remember that Africans generally are stubborn, and I just say this lightly. And so we think that for some of this industry, you find people reverting back to the status quo when, the economy opens and people are allowed to do what they want to do. So you have to really be careful. And Bastien mentioned something about being the first mover. You have to learn from the first movers, people that have actually gone ahead to build their business in this period, and figure out how to transform their model to fit your long-term trajectory.
Thank you very much to our panel. I think I've most certainly learned a lot. I hope that the audience has too. Before we go, Bastien, since we are getting our speakers' insights on their top business books and top books to read, do you have any options or any advice there on what people should be looking at besides Silicon Valley?
Yeah, that's I'd start with Silicon Valley. Now I've read I think it's called The Invested Investor. It goes back to what kind of investor you want in your business and what an investor should bring, what kind of value an investor should be bringing to you and your business. Because in the end, like I was saying earlier, it's getting an investor on board is a partnership, and the failure of early stage businesses is pretty much shared between the founder and the investors. So yeah, The Invested Investor, and I think it's Peter Foley, a UK guy.
Thank you very much. Thank you both for your time. Ladies and gentlemen, we've had Uwemakpan, Fund Operations Director of Ingressive Capital, Nigeria, and Bastien Maucet, Partner at Venture Capital in Mauritius.